Assalamualaikum and a very good day. I bid to Sir Azam and my fellow friends. My name is Nuraini Sofia binti Karmizi and my partner is Nur Aisha binti Rosli. Today we are going to present about chapter 6, Audit, Responsibility and Objective, which is classifications. So, firstly, in this chapter, you guys should know about the management assertions. What is management assertions? Management assertions are implied or expressed representations by management about classes of transactions, related account balance, and presentations and disclosure in the financial statement. It is important because classifications is under management assertions, which is under valuations or allocations. So, there are 5 categories of management assertions, which are assessing an occurrence, completeness, valuations and allocations, right and obligations, presentation and disclosure. Generally, classifications means the assertions is that all the transactions have been recorded within the correct accounts in the general ledger. Next, I will pass to Aisha and she will explain to you about the categories of assertions.
The audit assertions are primarily regarding the correctness of the different elements of the financial statements and disclosures of a company. Audit assertions also referred to as financial statement assertions and management assertions. Audit assertion can be broadly listed into 3 general categories, which are assertion of account balances, assertion about classes of transactions and events, and lastly, assertion about presentation and disclosure. For assertion of account balance, these assertions are generally pertaining to the end of period balance sheet accounts such as assets, liabilities, and equity balances. Next, for assertion about classes of transactions and events, its income statement accounts usually use these assertions. And for assertion about presentation and disclosure, this assertion deal with the presentation and disclosure of different accounts in the financial statements.
Next is classifications is under balance assertions. So, under the balance assertions, there are 2 types of balance, which are general balance and specific balance. General balance is amount included in client listing are properly classified. Classifications involve to determine whether the items in the correct general ledger account or not. For example of general balance is on the account receivable listing. Receivable must be separated into short terms and long terms and amount due from affiliates, officer and director must be classified separately from amount due from customer. Specific balance is related to the audit objective. It is the same as for transactions related audit objective. Each balance related audit objective should be tailored to the account balance being audited. For instance, all the accounts on the list arose from the normal course of business and are not due from related party. In that conditions, it falls under valuations and allocations, which is concern the classifications of account receivables and is therefore a part of classifications. Another example is there are one of manufacturing company which is Perlis Hardware Sendian Berhad. This manufacturing company applied the management assertions and balance related audit objective to their inventory. For instance, they properly classified their inventory items as to raw materials, work in process, and finished goods.
I will explain to you about assertion relating to classes of transactions for classifications. So, at first, we need to know what is transaction. Transactions are day-to-day accounting events that happen within a company. For example, the company receives a bill from the telephone company and posts it to accounts payable. That's called transactions. But when the company pays the bills, that's another transaction. The term classes of transactions refers to the fact that the company's various transactions are divided into categories in its financial statements. Like, transactions are grouped together. What is classification? Classification is that transactions have been classified and presented fairly in the financial statements. For example, the client has a high dollar equipment asset purchase. If the clerk assigns that transaction to repairs and maintenance expense on the income statement instead of the balance sheet's account, that action definitely affects the correctness of both the income statement and balance sheet, and it will mislead users of the financial statements. The assertion that transactions and events have been recorded in their own proper accounts. It means there is no misclassifications of any transactions and event. If a transaction relates to purchasing activities, it must be included in the purchase ledger. Similarly, all entries related to sales should be recorded in sales ledger, not anywhere else. And for example, salaries of office staff are classified and recorded as an administrative expense, while wages related to the product department are recorded as a production expense. The loan is correctly classified as current and non-current assets. In addition, salaries and wages costs must have been fairly allocated between operating expenses incurred in production activities, general and administrative expenses, and costs of personnel relating to any self-constructed assets other than inventory. So, basically, it means there is no wrong classification of any transactions and event. If a transaction relates to purchasing activities, it must include it in the purchase ledger. Similarly, all entries related to sales should be recorded in sales ledger. Relevance and uses of audit assertions. The understanding of the audit assertion is very important from an investor viewpoint because almost every financial metric used to evaluate a company's stock verifies through these assertions. The audit assertion carried out to verify the financial figures computed using data from the company's financial statements. If in case the figures are inaccurate, then that will result in a misrepresentation of the financial metric, which includes the price to book value ratio or earning per share. These are a few of the financial metrics which are being commonly used by analysts and investors to evaluate the company's stocks. During the process of an audit of a company's financial statements, the main idea of an auditor is to check and confirm the reliability of the facts and the figures recognized in the financial statements and capture the facts truly and fairly in the audit assertion. General audit objective and management assertion are different in the way that general audit objectives are designed to deliver a framework to assist the CPA in collecting suitable evidence needed by the third standard of fieldwork. General audit objectives are more useful for an auditor because they are more comprehensive and closely related to assisting the auditor in the collection of suitable evidence. If the equation of a fixed asset repair by a construction company is recorded on the wrong date, the timing objective has been violated. If the acquisition has been capitalized as a fixed asset rather than expense, the classification objective has been violated. The existing balance-related audit objective is related to amounts within financial statements, possibly being compromised, while the completeness balance-related audit objective deals with whether or not amounts that have to be compromised have already been included in the financial statements. The effects on financial statement of an over or understatement is the need for balance. Non-existent receivables lead to overstatement of a receivable, and failure to include a receivable balance can lead to understatement. Specific audit objectives are used as subsidiaries of general audit objectives, such as transaction-related, balance-related, and presentation and disclosure-related audit. Objective in order to pinpoint exactly what is needed. They are related to the three major groups in the way that they carry out those type of objectives in a more specific way. For the specific balance-related audit objective, all documented fixed assets exist at the date of the balance sheets. The general balance-related audit objective and the management assertion are both existent. The management assertion and disclosure-related audit objective are both classification and understandability. The disclosure-related audit objective and specific presentation fixed asset footnote revelation to conclude the fixed asset types and depreciation method applied, and useful life should be read properly.
Last but not least, the suitable audit procedure. Audit procedure are used by the auditor to determine the quality of the financial information being provided by their clients, resulting in the expressions of an auditor opinions. The exact procedure used will vary by clients depending on the nature of the business and the audit exceptions that the auditor want to prove. The test of the controls for classifications exceptions is accounts for sequence of shipping documents. For substantive tests, when there are cash and credit sales, it is important not to debit account receivable for cash sales or credit sale for collections of receivable. It is also important not to classify sale of operating asset as a sales. A common procedure is to examine duplicate sales involved for proper accounts classifications.